Welcome back to Smart Stock Sam, the channel that tracks institutional behavior, reads the on-chain data, and finds the asymmetric setups before the mainstream even knows they exist. Today, we are sitting at the intersection of two stories that cannot be separated. A bombshell short report just dropped, claiming that Ethereum is spiraling towards zero, and that BMNR, BitMine Immersion Technologies, is holding 4.4 million ETH on a foundation that is quietly crumbling beneath it. One side says this is a $7 billion paper loss waiting to become a real one. The other side says this is the most aggressively misread setup of the entire year. We are going to tear through every single claim with on-chain data, stress test the BMNR balance sheet, and give you the full picture that the short sellers do not want you to see. But here is the question worth sitting with before we dive in. What if a single software update really could permanently collapse the second largest cryptocurrency in the world and detonate a publicly traded company's entire treasury along with it? The bears are betting exactly that. Let's find out if they are right. To understand what is happening, we need to look at the two completely different stories being told right now. On one side, Culper Research is making the bear case. Their argument is that the Fusaka upgrade triggered a collapse in transaction fees, which gutted Validator yields, which is now driving a quiet exodus from the network. They claim the growth metrics are fake, the insiders are selling with inside knowledge, and that companies like BMNR are sitting on a liquidity time bomb. On the other side, the on-chain reality points to something completely different, a deliberate, years-in-the-making architectural transition to Layer 2 scalability, where the deflationary burn is intact, yields are still competitive, and institutional capital is flowing in, not out. One of these sides is fundamentally misreading the data, and the consequences of getting this wrong are enormous, both for Ethereum holders and for anyone with exposure to BMNR. So what actually happened with this upgrade that started everything? Think of Fusaka as a massive infrastructure overhaul. Previously, Ethereum operated with a gas limit of 45 million, creating a brutal bottleneck on the main Layer 1 chain. Fusaka pushed that limit to 60 million, but the goal was never simply to make transactions cheaper. The goal was to aggressively redirect user activity into faster, more efficient Layer 2 networks. Think of them as high-speed distribution lanes running alongside the main highway. By deliberately compressing costs on Layer 1, the protocol is forcing its own evolution. The bears saw the fee drop and called it a miscalculation. The data suggests it was the plan all along. Let's now go claim by claim, because this is where Culper Research's thesis begins to fall apart. Claim 1, the deflationary model is broken. Culper argues the 90% fee compression shattered the burn mechanism that keeps ETH scarce and valuable. They even allege that Ethereum's leadership miscalculated demand by up to 9 times. If true, that is devastating. But the February 2026 data tells a different story. Daily ETH burn was running at $1.2 billion. Even with lower fees per transaction, the sheer volume of activity, particularly Layer 2 batch submissions back to the main chain, means the 0.8% annual inflation rate is still being outpaced. The burn is not broken. It is running on volume instead of price per transaction. Same destination, different engine. Could that dynamic shift if volume growth stalls? That is the real risk to monitor. But right now, the deflationary flywheel is spinning. Claim 2. Validators are fleeing the network. The logic here is straightforward. Lower fees mean lower tips for validators, lower tips mean lower yields, and if Ethereum yields fall below US Treasury rates, rational capital leaves for safer ground. That logic is sound. The data is not cooperating with it. Ethereum Validator APR is currently holding between 4 and 5%. The 10-year Treasury sits at 4.2%. Ethereum is still winning that yield comparison. More importantly, the Validator withdrawal queue is flat. If a real exodus were underway, we would see a growing backlog of validators trying to unstake. That line does not exist. The exits are not crowded. And when you look at what that means for network security, the death spiral narrative essentially collapses. For Ethereum security to be genuinely at risk, the percentage of staked ETH would need to fall to somewhere in the 30 to 40% range. Today, 66% of all ETH is staked, approximately 19 million ETH locked into the network. The system is operating at nearly double the safety threshold. A sudden security spiral under these conditions would require a mass exodus of truly historic proportions. Is it theoretically possible? In crypto, almost anything is. Is there any current on-chain signal pointing toward it? None. Now, for the most creative claim in the entire report, the network growth is artificial. Culper asserts that 95% of new wallet growth is just address poisoning and wallet dusting spam, bots and noise inflating the numbers to make the network look healthier than it is. But their model makes a critical structural error. It does not distinguish between malicious spam and legitimate Layer 2 roll-up batch submissions. When you actually separate those categories, real user activity accounts for 96% of the network's transactional engine. Only about 4% is genuine spam. That is not a ghost town. That is a network the short sellers are systematically miscounting. And the real growth picture becomes even clearer when you look at where the activity actually went. While Layer 1 appears quiet on the surface, active addresses across Layer 2 networks like Arbitrum and Base surged 117% year over year. Fusaka is doing exactly what it was designed to do, pushing users toward faster, cheaper scaling infrastructure. Dismissing this because Layer 1 looks flat is like staring at an empty highway and concluding that nobody is traveling, while completely ignoring the high-speed rail running right beside it. The volume did not disappear. It migrated. That migration is the thesis, not the threat. Now let's address the insider selling headline, because it looked bad on the surface. Vitalik Buterin sold $40 million in ETH. Bears immediately called it informed insider selling, a founder quietly reducing exposure before a collapse. But here is what the timeline actually shows. This was a pre-announced, routine treasury management execution by the Ethereum Foundation, planned well in advance to fund what the foundation publicly described as an austerity period and a set of philanthropic commitments. Dmitry Buterin publicly called the short report authors attention-seeking clowns for mischaracterizing a scheduled budget line as a distress signal. That is not the language of someone watching a network unravel. That is someone watching opportunists spin a calendar event into a conspiracy. Now we get to the BMNR question, and this is where both stories collide directly. BitMine holds 4.4 million ETH and is currently sitting on over $7 billion in unrealized paper losses. On paper, that sounds catastrophic. The bears are betting that this pressure eventually forces a panic liquidation, which floods the market with ETH, which accelerates the exact death spiral they have been predicting. It is a clean narrative, but let's stress test the actual balance sheet. BitMine's staking operations generate $350 million in annual fees. They have over $3 billion in cash on hand. They are not just surviving this drawdown. They are operationally profitable and deeply liquid. Paper losses only become real losses when you are forced to sell. BitMine is not in that position. The bears need a liquidity crisis that the cash flow simply does not support. So here is the question that actually matters for BMNR investors. Is this the moment of maximum fear before a recovery? Or is something structural genuinely breaking underneath the surface? The competitive landscape is where we have to be honest about the real risks. Solana is not a fabricated threat. User growth, retail momentum, transaction speed, Solana has genuine advantages right now, and we are not going to pretend otherwise. But Ethereum has a moat that is extraordinarily difficult to replicate. It remains the undisputed leader in total value locked and institutional adoption. In 2025 alone, Ethereum absorbed $4.2 billion in institutional net flows. Individual investors chase momentum. Institutions building critical financial infrastructure need the security guarantees that only Ethereum's settlement layer currently provides. That institutional gravity is what underpins BMNR's entire treasury thesis. When we stack up the full scorecard, here is what the data actually shows. Every major allegation in the Culper Research thesis has been either debunked or fundamentally mischaracterized. The deflationary burn? Debunked. Volume is outpacing inflation. Validator exodus? Debunked. Yields beat treasuries, and the withdrawal queue is empty. Network spam? Mischaracterized. 96% of activity is legitimate. Insider selling? Mischaracterized. It was a pre-planned, publicly disclosed treasury action. BMNR liquidity crisis? Debunked. $3 billion in cash and $350 million in annual staking fees say otherwise. The death spiral is a narrative built on selectively isolated metrics, stripped of their architectural context. The real post-Fusaka cycle looks nothing like the bears are describing. Layer 1 costs drop. Fusaka is working as designed. That compression drives Layer 2 usability through the roof, producing the 117% growth in L2 active addresses we just walked through. Those Layer 2 networks batch their transactions back to the main chain, creating massive aggregate volume. That aggregate volume sustains the ETH burn rate, keeping the network deflationary even as it scales toward millions of new users. That is a flywheel, and BMNR, sitting on 4.4 million ETH generating staking yield, is positioned directly in the path of that flywheel's upside. Before the final verdict, a word that matters. Nothing discussed today is financial advice. Smart stock. Sam produces educational content and on-chain data analysis for informational purposes only. All investing involves risk, including the potential loss of principal. The analysis here reflects publicly available data and does not constitute a buy or sell recommendation for ETH, BMNR, or any other asset. Always conduct your own research and consult a qualified financial professional before making any investment decisions. Here is where we land. Ethereum is an engineered success, not an accidental one. Fee compression was not a miscalculation. It was the mechanism designed to push global transaction volume onto Layer 2 at scale. The core financial pillars of the network, deflationary burn, competitive validator yields, and a security buffer nearly double the minimum threshold, remain structurally sound. And BMNR? The bears need a panic sell that a $3 billion cash position and $350 million in annual staking revenue simply do not support. The death spiral makes for a compelling short thesis headline. The unbroken ledger of on-chain data tells a completely different story. If you are fading Ethereum and shorting BMNR right now, you are not just betting against a coin and a stock. You are betting against the settlement infrastructure of the future internet and doing it at the moment of peak fear. Drop your BMNR take in the comments. Are you buying it or staying on the sidelines? Smash that like button if this breakdown gave you something the headlines missed, and make sure you are subscribed to Smart Stock Sam so you never miss the next asymmetric setup before the crowd finds it. I will see you in the next one.